Let's be honest. The stock market sounds exciting until someone says the PE ratio is overvalued relative to the Fibonacci retracement. And suddenly you're like, Fibonacci who? If you've ever nodded along in confusion at a dinner table while someone bragged about their portfolio diversification, this video is for you because today I'm breaking down the entire stock market from A to Z in plain, everyday English. No fancy jargon, no Wall Street attitude, just the stuff you actually need to understand before you invest your first dollar. So grab your coffee or your calculator and let's make the market make sense. 1. The basics. Owning a piece of the pie. A stock or share is simply a slice of ownership in a company. Buy one share of Apple? Congratulations! You now technically own a piece of the iPhone empire. Equity is just a fancy word for ownership. It means your claim on the company's assets and profits. So when someone says, I've got equity in my startup, what they really mean is, I own part of it, and hopefully it'll be worth something one day. A stock exchange is basically Amazon for businesses, but instead of buying headphones, you're buying companies. The biggest ones, the New York Stock Exchange and NASDAQ, and every company listed there has a ticker symbol, a short code like AAPL for Apple, TSLA for Tesla, and Google for Google. Your portfolio is your personal collection of investments, like your financial playlist. A little Apple, a little Microsoft, maybe an index fund remix. 2. Investors, brokers, and how it all works. An investor is anyone putting money into something, whether that's stocks, property, or your cousin's next big app idea. But smart investors aim for long-term growth, not get-rich-quick chaos. A broker or brokerage is your middleman, the platform or person who helps you buy and sell stocks. Think Robinhood, Fidelity, or eToro. And that little commission they charge? That's their cut. Luckily, most apps now offer zero commission trades, because nobody likes paying fees. 3. Public versus private companies. A public company sells its shares in the stock market, like Apple, Amazon, or Coca-Cola. They're required to report their earnings regularly, so we can all judge them. A private company doesn't trade publicly. It's owned by a few investors or founders. Think IKEA or SpaceX. You can't just buy shares in those, at least not yet. 4. Dividends, losses, and returns. A dividend is like a thank you gift from the company, a piece of profit they share with shareholders. Coca-Cola, for example, pays dividends every quarter. So if you own their stock, you might get a little cash just for holding it. A capital loss happens when you sell for less than you bought. Bought at $100, sold at $80? Ouch, that's a $20 loss. Welcome to investing. Yield shows how much income you're earning from your investment, in percentage terms. If a $100 stock pays $5 yearly, the yield is 5%. And ROI, or return on investment, tells you how much profit you made. Invest $1,000, earn $200. That's a 20% ROI. 5. Compound interest, the silent money multiplier. Compound interest is the secret sauce of wealth. It's when your money earns interest and then that interest earns more interest. That's how the rich get richer, not magic, just math. 6. Orders, stops, and strategy. A market order means buy it right now. A limit order means buy only at this price. A stop loss means if it drops too low, sell it before I cry. A trailing stop is like a smarter stop loss that moves up with the stock's price, locking in profits as it climbs. 7. Stock types. You'll hear about common stock, ownership plus voting rights. Preferred stock, no votes but steady dividends. Blue chip stocks, the big dogs, Apple, Microsoft, Coca-Cola, stable and reliable. Growth stocks, all about potential, high risk, high reward. Hello Tesla. Value stocks, undervalued gems, the clearance section of the market. Dividend stocks, they pay you just for holding them. Cyclical stocks, rise and fall with the economy. Defensive stocks, the essentials, food, healthcare, power, steady even in recessions. Penny stocks, cheap, risky, and sometimes scammy. Handle with care. 8. Market mood swings. A bull market is when prices charge upward. A bear market is when everything's falling. A correction is a small dip, around 10%, and a crash is a free fall. Volatility measures how wild the price swings are. High volatility equal sign drama. Low volatility equal sign chill. 9. Key numbers to know market. Cap how big a company is. EPS, profit per share. PE ratio, price versus earnings. A quick way to tell if a stock's cheap or pricey. Dividend yield. Dividends as a percent of stock price. Beta, how risky it is compared to the market. 10. Revenue, profit, and ratios revenue equals total money in. Net income equals what's left after all expenses. Operating margin equal efficiency of the core business. Profit margin equal profitability. Debt to equity equal how much they owe versus own. ROE equal how well they use shareholder money. 11. Funds, ETFs, and REITs ETF. Exchange traded fund. A basket of stocks you can trade easily. Instant diversification. Mutual fund, professionally managed, trades once daily. Index fund, tracks an index like the S&P 500, cheap and consistent. REIT, real estate investing without buying a single house, and it pays dividends. 12. Advanced terms, simplified hedge fund. A fancy, risky fund for the ultra-rich. Options, contracts to buy or sell at a certain price. Use with caution. Futures, similar to options but binding. Bonds. You're lending money to governments or companies. They pay you back with interest. 13. Major market indexes, S&P 500. Top 500 companies, the gold standard. Dow Jones 30 industry giants, old school indicator. NASDAQ, tech heavy, think Apple, Google, Tesla. Russell 2000, smaller up-and-coming U.S. companies. VIX, the fear index, measures market nerves. 14. Trading styles and investor types. From day traders, blink and you miss it, to swing traders a few days or weeks, to long-term investors like Warren Buffett. There's no one-size-fits-all. You might be a value investor, a growth chaser, a dividend collector, or a contrarian who buys when everyone's panicking. Just don't let FOMO, fear of missing out, control you. It's one of the biggest portfolio killers. 15. Market manipulation and hype traps. Ever heard of a pump and dump? It's when people hype a cheap stock, drive it up, and then dump it for profit, leaving everyone else with the losses. Moral of the story, if someone on the internet says, this stock will 10x by Friday, run. Technical and fundamental analysis. Technical analysis, reading charts like a detective, spotting patterns, trends, and signals. Fundamental analysis, looking under the hood, studying profits, debt, and company health. Tools like moving averages, RSI, and MACD help traders time their moves. Fibonacci retracement and support/resistance are used to predict where prices might bounce or break. 17. Leverage, risk, and returns. A margin account lets you borrow money to invest, doubling your buying power but also your risk. Leverage can turn small moves into big wins or big losses. Alpha measures how much you beat the market. Sharpe ratio measures how efficiently you earn returns based on risk. And diversification, the golden rule, means spreading out your investments so one bad stock doesn't wreck your whole portfolio. Now you've got the language of the stock market down. You can walk into any finance conversation and actually understand what they're saying. If this video helped simplify things, smash that like button, subscribe for more easy-to-digest finance videos, and drop a comment with any confusing stock term you want me to break down next time. Because finance doesn't have to be fancy. It just has to make sense.